This week in AI-driven investing, the signal is not one flashy launch. It is the speed at which AI is moving deeper into the financial system. Across the latest posts from AI-driven investing, banks are using AI to chase new assets, research platforms are scaling machine speed analysis, and investors are putting serious money behind the tools that sit underneath modern finance. The through line is simple. AI is no longer being treated as a side experiment. It is becoming part of the revenue model, the research workflow, and the infrastructure stack. The first clear theme this week is distribution. Citi Wealth is rolling out an AI advisor called Citi Sky to pursue as much as $5 trillion in outside client assets. And the strategic point matters more than the product demo. AI is being used to extend coverage, answer questions after hours, and push wealth businesses beyond the limits of traditional advisor headcount. The same pattern shows up in newer platforms. Savvy Wealth is building AI directly into advisor workflows, while robo-advisor adoption and family office portfolio tracking point to a market that increasingly expects digital, always-on financial interfaces. In other words, firms are not using AI only to save money. They are using it to widen distribution and win more wallet share. The second theme is that investment research itself is being rebuilt around machine speed. AlphaSense's latest funding round is a good marker because it values not just another software vendor, but a research layer already used by much of the institutional market. At the same time, reports on firms like Magnetar and the Mercer survey show the same operating model taking shape. AI handles scanning, summarizing, and idea generation, while people keep the final investment decision. That distinction matters. Adoption is real, but full autonomy is still rare. The edge today is not that machines are clearly better stock pickers. The edge is that they can cover more ground, surface more signals, and compress the time between information and action. The third theme is where the money is going. The standout funding stories are not generic AI claims. They are focused bets on the picks and shovels of financial infrastructure. Beervox raised $175 million around AI-native compliance and surveillance. Wealth.com and Capsa AI are building deeper operating systems for advisory and private capital workflows, and the broader venture backdrop suggests that AI is capturing an unusually large share of new funding. Put together, that means investors are rewarding products that become plumbing inside financial institutions. The winners are likely to be the platforms that sit inside compliance, research, planning, and execution, where switching costs are high and usage compounds over time. The last theme is the gap between adoption and autonomy. Deloitte found that AI is now widespread across large family businesses. Mercer found that most asset managers have already integrated AI into at least one process, but only a small minority are willing to let it make the call on recommendations or trades. That tells you where the market really is. Finance is moving quickly toward AI-assisted workflows, but not yet toward widespread machine sovereignty. For now, the durable model is human judgment sitting on top of AI acceleration. The next big question is whether better data, better controls, and better compliance tooling eventually narrow that trust gap. The takeaway from this week's AI-driven investing posts is that finance is entering a more mature phase of AI adoption. Revenue teams want broader client coverage. Research teams want faster synthesis. Investors want infrastructure that can plug into real workflows and survive regulation. That is why the most interesting stories are not isolated demos. They are signs that AI is being wired into the core of how financial institutions grow, analyze, and operate. The open question now is, who graduates from AI-assisted work to AI-trusted decision-making? That is where the next wave of value will likely be created.